We're going to look to make an adjustment to RUT EIP. These are December 15 option expiration options. We've been in this trade for about 36 days, and there are 24 days left until expiration. So a standard adjustment for a trade like this would be to add tier 2 when price crosses long upper put on the upside, which is 1500 in this trade. However, with time running down, I don't feel the best way to make an adjustment here is to add tier 2 and then potentially add tier 3. Reason being is we are seeing Russell expand to the upside, and now we're trading at or near all-time highs. And in last week, we saw price come down to about 1460. We saw a pretty sharp reversal with some follow through. So overall, I do think that we are going to see more upside at this point. It is getting a little overbought on the short-term basis, but as we can see, overbought can stay overbought a lot longer than anybody could imagine. So with this kind of an adjustment, if we just look at adding tier 2 here, right, this would be a broken wing put butterfly added 20 points above tier 1. So this butterfly would be centered around 1490 with long wings at 1440 and 1520. And what this will do, this will actually add more negative delta to this trade. It's going to boost theta in a big way. However, going back to negative delta means this trade needs to the underlying needs to trade lower for this trade to work. And if I am looking for more upside at this point, I don't know if I want to add more negative delta to this trade. I do think that the path of least resistance here is, instead of adding tier 2 at 1490, I would just look to roll my long upper put from 1500 down 10 points to 1490. What this will do is this is going to take my net delta from -3 to about +3. It's going to slightly increase my theta. What it also is going to do is it's going to increase risk on the downside. However, it's going to decrease or increase or maximize profit on the upside. What that means is that if Russell goes to 1550, 1560 or above and stays there over the next 3 to 4 weeks, this trade can't lose money on the upside. The only risk here is on the downside. And if we look forward just a couple of weeks, say we could look at this not next week but the week after, right? So options are currently pricing in the move to the downside down to about 1480. So if we're seeing a move based on what current options are pricing in to the downside, we make this adjustment and we see Russell trade down to 1480 over the next couple of weeks, this trade is actually going to improve. And if we're seeing a move to the upside based on what's currently being priced in, this trade is going to be up just about 10% on risk. So again, no risk on the upside making this adjustment. Only risk here is on the downside. As long as we stay above 1480 over the next 16 days, this trade is going to be in a really good spot. So the only thing we need to really worry about is Russell trading underneath 1500 and down to about 1480 over the next couple of weeks. This is probably going to be the last adjustment I'm going to make to this trade. What's going to end up happening is, going into expiration, if the price is still above, well, our break even down to about 1445, but as long as price stays above 1490, which is the long upper put of this trade, all options are going to expire worthless. And this is a cash settled index, so we won't need to do anything as far as closing out this trade. Again, with this adjustment, we are going to maximize our profit on the upside we're going to take a little bit more downside risk, and that's what we need to be focused on. So if we do see price dip below 1500, we may need to make another tweak or two, but as long as we stay above 1500, and then we can go as far as 1480 over the next 3 weeks, this trade is going to be in a good spot and we're going to make some money.